The countdown to the end of Q2 is on. That means we'll be entering the second half of this year. So before we dive in, I'm joined by Stephen Guilfoyle of Sarge 986. Sarge, great to have you here today.
The pleasure is mine. Thank you, Remy.
Well, as we head into the final week of Q2, we have plenty of central bank speakers on tap. It's not just the Fed Reserve, but we also have other central banks. And when it comes down to rate differentials, what do you expect to see in the second half of this year?
You know, about 2 months ago, somebody on the air asked me the same question, and I really thought rates were going to go higher. I think I gave a target of 2.75% for the 10-year, which is still possible. But it's sure looking less and less likely, and bond traders are surely betting against the Federal Reserve being able to raise interest rates at this point. I think the 210 yield curve is down to 0.78 something this morning. So we're really seeing the ball rolling the wrong way if you're a central banker.
And of course, when it comes to central banks as well as investors, everyone's paying attention to economic growth. Earlier today, we got that durable goods report, and it did come in below expectations. Of course, as we head into the rest of the week, we'll get more economic data out from the U.S. But given where we are right now, what do you expect to see in terms of growth?
You know, we're really disappointed. I mean, Atlanta came out today. I think they kept it at 2.9%, which is where it was at. So I guess today's durable manufacturing report actually was in line with their poor projections. Otherwise, if we had gotten what we were expecting, I guess we would have seen a little pop from Atlanta on GDP. You're going to get something close to that 1.2 for the first quarter in the final reading this Friday. The second quarter is going to look better, but it's not where we want to be. We still are in that era of suppressed growth, which, if you define a depression, what is a depression? A long era of suppressed growth, which, yes, we do have the longest expansion on record, but we also have a pretty long era that, by that definition, would fit the term depression. So I don't think anybody's celebrating this 8-year expansion that we're having. I think a lot of people that used to make $75,000 a year are putting pickles on a shelf somewhere. So it's not roses right now. It's a difficult environment, and I don't know how the Fed gets out of it. Certainly not by talking hawkishly like John Williams did this morning.
And Sarge, it's interesting because we're here on a Monday, and earlier the New York Fed Reserve also pared back their growth expectations for Q2. And the BIS released their report on Sunday, and their outlook was not altogether bearish. And they also pointed out that some of the risks that were apparent in the aftermath of the financial crisis are still around. So, of course, we'll have to see what happens in the coming days as well as coming weeks. But what do you make of the situation in terms of geopolitics overseas?
Well, we know that geopolitically, North Korea still poses a problem. We know that terrorism is not just a problem that exists, but a growing problem throughout much of Europe and the rest of the world. Yet these things don't seem to affect markets all that much, nor economies. I mean, the European economy, though it is still hitting rough patches left and right, is doing better than it was. They're talking about tightening policy, much like the Fed is, but I don't think they're going to go there too quick. I don't think the Fed's going to be able to fulfill what they're speaking about also. Geopolitically, as long as nobody does anything crazy, and by crazy I mean something blowing up, I think we can continue at least on this trajectory that we're on, which nobody's thrilled with, but the markets seem to be doing well. If you're a bond trader or a stock trader, hey, prices are at or near all-time highs. So, and that's what I am, so I really can't complain, but I'm also used to work as an economist, and these things do bother me.
And last but not least, in today's report today, you did write rotation, schmotation. So what do you expect to see? Are we going to see any more trend reversals?
Well, when I wrote rotation, schmotation, I was talking about technology and healthcare, which are the two best sectors if you go back a week, if you go back 3 months, if you go back year to date, or you go back 5 years or even longer. So I'm going to be represented in those groups for the next 6 months, for the second half of the year. Now, we got a little pop there in the financials early in the year based on the Trump trajectory. Everybody was excited about that. It didn't really pan out, or at least didn't pan out yet. Financials are still in play because, one, regulation, but we also have the bank stress tests, which are going to allow them probably to raise dividends and to buy back some shares. So right now, that's the excitement. That's why you're seeing a little bit of leadership from that group. But I don't think, given where the yield curves are, that that's sustainable, at least for now. And maybe later in the year, we'll see how that goes. But you're definitely going to want to be in the healthcare names broadly, I think. And technology is a place where if you haven't been there, you've missed a lot. I would get in very small increments at this point if you haven't been in that space. But if you're already there, I wouldn't be getting out.
Okay, Sarge, well, always a pleasure to speak with you, and have a great 4th of July.
Oh, you too, Remy. Thank you.